According to a top crypto research firm, this sector is set to increase by over 26x by the year 2030. And that is just the base case. Some analysts have even suggested, according to this report, that this sector could exhibit gains of up to 60x plus. Of course, I'm talking about the real-world assets sector, which, via the Boston Consulting Group, has asserted to be one of the highest growth potential sectors in the entirety of crypto. So in today's video, I want to reveal my number one altcoin pick in this sector and break down why I think it has significant upside in the future, and hence why in the interim I am adding this to my portfolio. If you are new to the channel, make sure you click the subscribe button down below and turn on post notifications so you don't miss a single video I upload here on this channel twice a week. Without further ado, let's get straight into the video. So what are real world assets? Before I tell you my altcoin pick, I want you to understand what this sector actually is, because these are some massive numbers which show a base case of a 26x by the year 2030, which is obviously 7 years away, and the more aggressive case, as you can see here, which would result in over a 100x gain from the current market capitalization of the real world asset sector, which sits around $0.6 trillion or $600 billion. So clearly this is a sector with a lot of upside, but what exactly are real world assets? Well, pretty much it is quite simple. Real world assets in cryptocurrency are assets which are taken from the real world. So think tangible assets like real estate, gold, collectibles or cars, or intangible assets such as equities, government or corporate bonds, carbon credits, or trade finance that are issued in the form of a token on the blockchain. For example, you could take a real property, then you could tokenize it on the blockchain, fractionalizing the shares of that underlying property to allow investors to easily access or invest in that property on the blockchain, and they could buy fractions of that house. This is great for industries which are prohibitive due to the barrier to entry of entering that industry. And it also makes it more efficient as you are able to transact a real asset, in this case, a house or an apartment, on the blockchain instead of having to go through the rigmarole of buying it in real life. This can also, though, apply to a variety of other intangible assets, so not just real assets, which I think is actually the most interesting growth vertical of this sector. For example, equities or government or corporate bonds, which would enable you to transact bonds and earn yield on the blockchain via accessing what has traditionally been considered to be a real world asset. And this could extend to all sorts of fixed income products. This could extend to corporate debt, personal debt. Like, there are huge use cases for this in the future. So in today's video, I want to break down what some of these potential use cases are and how as an investor you can capture upside. Look, crypto has a big problem right now. The big problem with DeFi is that back in 2020 and 2021, the Fed funds rate was effectively zero, meaning interest rates were effectively zero, meaning if you wanted to search for yield, you simply couldn't get it in traditional alternatives. So a lot of people turned to DeFi in order to get yield on their assets. You could get 20, 30% plus on stablecoin yields. You could get 20, 30% plus on your Ethereum. And the birth of DeFi summer really led to a lot of capital inflows into DeFi as investors were starved for yield, and they turned to DeFi in order to get that yield. But what's happening now is traditional rates are becoming much more competitive with the Fed funds rate over 5%. Now you can lock your money in treasury bonds and yield over 5%, not have to inherit all the risks that you would be investing in crypto and DeFi, and still get a pretty competitive return. Meanwhile, DeFi returns across the board have been diminishing, and now it's even hard to earn 3-4% on your Ethereum, whereas in the past that was super easy and thus a very attractive investment proposition versus the traditional world. So we are in a place now where DeFi yields are low. There's no real incentive for people to put money or stake money in DeFi when they could get it in the real world. They can simply invest in fixed income assets and earn even better yields than they would in DeFi. Doesn't make sense, right? Well, this is where real world assets come in, and this is why I believe it's one of, if not the biggest growth verticals in crypto, because it finally allows DeFi to harness the potential of real world income generating assets. And this has huge potential because you can bring a lot of the assets which are prominent in the real world and you can start to utilize them in DeFi, and you get all sorts of benefits. As you can see in front of you, the benefit in DeFi is it's a much more efficient market oftentimes than the traditional finance market, which has lots of intermediaries like funds, banks, clearing houses, which take management fees, which take transaction fees. In DeFi, theoretically, you can match the investors, so the buyers and the sellers of assets, with the assets themselves and do that in a peer-to-peer decentralized fashion. So I think overall, in the broad scheme of things, DeFi can offer a huge efficiency benefit for a lot of assets. Now, not every single asset, but certainly for a lot of assets versus investing in them in a traditional sense with the bank or with a fund. So there clearly is a value proposition here. And that's why I think there's huge upside in the real world asset space, not only because it's solving one of DeFi's biggest problems today, which is essentially a lack of yield, but it's also going to bring in potentially trillions of dollars into the space. I mean, you saw the graphic before. The Boston Consulting Group asserted that we could be looking at $16 trillion, and that's a conservative estimate of inflows into this sector by the year 2030, and that could even grow to their best case, which is $68 trillion. That's a whole lot of money coming into crypto, and of course, there are a whole lot of beneficiaries. You have the protocols, which are enabling users to trade these assets or earn yield on these assets. You also have the layer 1s and the layer 2s, which are powering the protocols, and they're taking sequencer fees from the usage of those networks in the form of gas. So across the board, there will be a lot of trickle-down effects if this kind of liquidity does come into crypto, and that's why it remains one of the strongest growth verticals in crypto. That is going to create lots of opportunities on the protocol side, but also on the infrastructure side. And in today's video, I have one pick that I want to discuss with you on the protocol side, but I think it's also important to note that this is a vastly expanding and developing crypto ecosystem, which could have lots of opportunities. You can see in front of you, we have the entire RWA ecosystem mapped out, from emerging credit markets to refi, collectibles, agriculture, trade finance. Real estate has been one of the biggest use cases to date, and that's clearly one vertical that protocols have been really keen to adopt because it does offer really clear efficiency benefits, as we discussed before, because there's lots of fees attached to investing in real estate. There's a big barrier to entry when it comes to investing in real estate. If you can decentralize that entire process and tokenize properties and enable investors to get in for a lot less than what a property costs, which in most cases, in most big cities, is like over $1 million now, then that is a huge value proposition to users wanting to enter that market. So the entire real world asset market is flourishing, and I think it's going to thrive in the future. And it was one of the biggest talking points that I heard from Token 2049. Obviously, I went to the conference in Singapore, and this is pretty much what everyone was talking about. It was the talk of the town when it came to like the builders and the VCs, and everyone that was in the know. They were all pointing towards the real world asset sector as being one of those big growth opportunities. And currently looking at where it sits in the entire categorization of crypto assets, it's ranked number 8. DEXs, bridges, lending protocols, CDPs, services, yield-bearing protocols, like these all come in higher than real world assets. And I think one day we're going to see real world assets flip a lot of these and enter the top spot, or at least the top 3 for crypto categories. So we're kind of preemptively going to position ourselves for that narrative, or at least that's what I'm looking at doing, by starting to allocate some of my portfolio towards protocol side investments and infrastructure side investments in the space. So let's talk about a few of them, and let's of course talk about the number 1 pick that I do have in this sector that I want to discuss today, that is also building a lot more than just a real world asset protocol layer. So the first one that most of you guys would know is probably MakerDAO, and they've been a major beneficiary of this trend, considering their MIP65 offering has resulted in a huge spike in total value locked entering the MakerDAO ecosystem. And basically what this initiative is treasury bonds coming on-chain, and MakerDAO enables you to earn yield on those assets in a variety of vaults. I think they have over 10 to 15 vaults listed on the platform, which enables you to earn yield on these assets, and you can see some of those listed here. So MakerDAO has been definitely paving the way in this space, and it's probably the number 1 protocol that I think of that's synonymous with real-world assets. It's not actually my pick for today's video, but I'm just kind of talking about Maker in the context of being the leader here, and giving us an example of a protocol that is really pioneering this space. So that's a super interesting one. Before we get, of course, into my top pick, another interesting one which hasn't actually launched yet, but which is about to launch via an IDO, is Soil. Now, for full transparency, I'm invested in Soil, and Soil is an official show partner, but I thought today would be a great time to talk about them in the context of real-world assets, because they're a protocol that allows you to earn up to 14% yield on real-world assets in a fully regulated DeFi manner, which is managed managed by a team of professionals. They've partnered with Big Brain Holdings, Mount TFI, Polygon, Market Across, Seedify, who's actually doing their launch alongside Engine. You've got Fractal, you've got WH Partners, Headman, a lot of partners as well. Now, how does it actually work? Well, essentially, it's a debt marketplace that provides accessible financing to businesses and high yields on stablecoins for crypto investors. So what it does is it connects traditional finance with the crypto world, allowing corporate debt and fixed income investments to be transacted between these two parties. And if you want an example of how this looks, I'll show you in front of you. You've basically got your crypto investors, which lend stablecoins to the protocol, which is Soil. Soil provides liquidity to traditional players in the fiat world who essentially provide a yield because they're borrowing those assets, which goes back into the protocol. Then the protocol pays out crypto investors for lending stablecoins to Soil. So once the protocol is launched, what you'll be able to do is stake your stablecoins in the protocol, and then the protocol is that intermediary, that decentralized intermediary that can lend your money to the TradFi world to enable you to earn yield on your stablecoins. In this case, up to 14% on USDC. But this growth vertical, I think, has a lot of potential because there are a lot of problems in the DeFi world and the TradFi world when it comes to their business models. And I think that by incorporating real world assets, you can solve some of these issues on both sides, as you can see highlighted in front of you. And they're going to solve these problems by bringing tangible yield to the crypto world, mitigating risk with their multi-chain guarantee fund, providing stable and diversified collaterals across the board, and they're going to cooperate with private debt funds in order to get the best possible yield for the customers. And of course, they are fully regulatory compliant, which is a great thing as well. So now, of course, I'm not saying you have to invest. For the people that are interested, I recommend you do check it out. I'll leave a link in the description below. As again, full disclosure, I said I'm an investor and I'm also a partner with them. If you're interested in learning more about their IDO, it's on the 5th of October. It's going to be via Engine Starter and it's going to be via Seedify as well if you want to get involved. But I recommend you just learn more about the protocol first, and how you can do that is checking out their Twitter and their website using the description below. But I thought it was a great one to mention that is on the protocol side, because I mentioned protocol stuff, and then I mentioned you've got your infrastructure layer as well. Soil is one of those real world asset specific protocols, and on the infrastructure side, you've got your layer ones, your layer twos, all these blockchain built platforms that are facilitating the deployment of a lot of these dApps. So Soil, link in the description below. And now let's get into one of my favorite picks in this sector, which, if you were savvy enough to look at the tabs above, you would know is Frax Finance. And I want to talk about exactly what Frax Finance is doing in this space, and also why it's a lot more than just a real world asset protocol. So Frax Finance, essentially, at its crux, is a stablecoin. It's a decentralized stablecoin. It started as algorithmic. They've changed their model over time, so it's become more collateralized over time in the face of UST. And Frax has really come a long way since those early days. Like, they're doing so much at the moment, and I want to break down exactly what they're doing and the industries that they're pioneering. One of those industries, of course, is real-world assets via their endeavors into that sector. But the way I would think of Frax is essentially it's a DeFi powerhouse, right? They've got their lending protocol. They've got their Frax ETH, which is their liquid staking protocol. They're going into real world assets. They're launching their V3. They've got a lot going on. So it's like an umbrella. It's like a DeFi suite of products that is all encompassing under the Frax brand. So you've got to think of it as something bigger than just a real world asset protocol, or bigger than just a liquid staking protocol, because the team has shown the proclivity to continue to push out new updates and new products throughout the bear market. And I think that's what gives me confidence in Frax, because their team has been so amazing throughout a period where, a lot of teams have stumbled and faltered. They've continued to just keep shipping. So let's talk about some of the things that they are shipping, break them down, and then I'll give you my thesis. So firstly, the thing you've got to understand is it's a very broad ecosystem. As you can see in front of you, I've outlined this map of opportunities, which was written by Stacey Murr. They did an amazing job of putting it together. If you want to screenshot the video, go ahead right now, because this will essentially be your guide to understanding how Frax works. They have their liquid staking, and a percentage of yield goes back to the Frax treasury, which pays out VEFXS stakers. They have Frax Swap. Swap fees also go back to Frax stakers, so it's all interlinked with the token. You do have their stablecoin as well. You've got Frax Ferry, which is their bridge. You've got Frax Chain, which is their upcoming layer 2 blockchain, which I'm going to discuss. And then you have Frax Lend, which is their borrowing and lending protocol. So as I said, it's an all-encompassing DeFi powerhouse protocol that's providing a lot of offerings. And one of those offerings is, of course, their endeavor into the world of real-world assets. So let me explain what they're doing on the real-world asset side. So essentially, the Frax founder Sam Kaisman has proposed using a US corporation as a conduit for Frax to custody cash deposits, reverse repo contracts, treasury bills, and other traditional financial instruments. FinRes PBC is a non-profit C corporation domiciled in Delaware to provide the Frax protocol access to safe cash equivalent assets and near Fed rate yields for the benefit of all without seeking to profit from this relationship or charge fees. Frax V3 is a unique system of managing its off-chain risk that hasn't been built before. Our RWA strategy, unique borrow AMM loans and debt system, makes it so that constant redemptions of real-world fiat or treasuries aren't needed to keep Frax V3 stable, Kaisman told The Defiant. In the proposal, which we can see recently did go live on August 4th, now up for debate for the next 3 days, so it's officially been voted on, Kaisman detailed how the partnership with FinRes PBC will benefit the platform's Frax V3 RWA asset strategy, which, and this is the most important part, is aimed to bring traditional financial assets on-chain, for example, US Treasury bills. The company's sole public benefit mission is to give on-chain users access to off-chain cash equivalent RWAs. So they have a lead bank, which is a Kansas-based regional bank, which will act as FinRes PBC's partner, and the company is actively expanding its banking and financial relationships with compliant and crypto-friendly financial partners, which will of course facilitate Frax's V3 endeavor into real-world assets. And for the sake of transparency, they're going to provide monthly assessment asset reports of the assets and reserves it holds on behalf of the Frax protocol. So of course, whenever you want to bring real-world assets onto the blockchain, you need to have compliant banking partners. This proposal was the first step to gaining those partners, which is going to allow, via their V3, users to access these yield instruments on-chain via the Frax protocol. So this is a pretty exciting endeavor into the world of real-world assets. And no, Frax isn't just only a real-world asset protocol, as I alluded to before, but the reason why it's one of my top picks in this sector is because I like the fact that it's not solely reliant on the upside of real-world assets. Of course, that's a vertical with huge upside, as we've just spent roughly 20 minutes discussing. But the good thing about Frax is you kind of got that hedge. You've got multiple pretty strong catalysts all encompassing the Frax ecosystem. So you know if one of these kind of fails, all they need is to hit one of them in order to still succeed as a protocol. So I do like protocols which are all encompassing or have a variety of catalysts, because it puts less specific risk on one catalyst. You've got the liquid staking catalyst, you've got the real asset catalyst, you've got the bridge, Frax chain, you've got their stablecoin, their underlying stablecoin. So if something were to happen to one of these, or if one was to take off, you still know the protocol overall is going to succeed and do well. So that's what I do like about Frax, the fact that it is a super interesting ecosystem. Now, liquid staking is clearly this year the strongest contributor to Frax as an ecosystem, or at least one of them, considering they've been able to dominate the space with very competitive yields. As you can see in front of you, the yields on Frax staked ETH are 4.38%, which is the highest out of all of their competitors, and they've been able to gain market share pretty much in a space which Lido and Rocket Pool have dominated. Frax has been able to slowly eat into the market share. And what they're doing is offering an ETH, just like Lido, liquid staking derivative, essentially enabling you to stake your ETH whilst maintaining capital efficiency by getting a staked Ethereum in return. And then, of course, you can do whatever you want with that. You can borrow against it. You can stake it to earn more yield. It offers you a lot of flexibility, and it, of course, enables you to bypass that 32 ETH minimum that you would get from spinning up your own validator, which is super attractive for the majority of retail, right, which don't have 32 Ethereum. So there's a strong value prop here, and that's been a huge contributor behind Frax's growth, but I think there's still a lot more growth potential there, considering that the Ethereum staking ratio is only around 20%. Comparable blockchains like, Cardano and Solana, a lot of these protocols have staking ratios much higher, right, in the 40-50% range, which is the average across the layer 1 ecosystem. ETH still sits at 20%. So there's still like a 30% wiggle room for growth on Ethereum as an asset, which of course means, Frax can just get a portion of this, 1 to 2%, 3%. There's still huge upside in terms of the amount of protocol fees they're going to be able to generate through staking. So that's definitely one catalyst that has upside alongside the Frax real world asset initiative as well. Frax Lens, another interesting one. This deployed last year. It's essentially a money market platform which enables on-chain borrowing and lending, which I think is really cool. They're using the Chainlink data feed in order to facilitate this. And what it does is enable the protocol to mint new Frax through the borrowing and lending process, and allows the protocol to directly lend Frax, which is their stablecoin, of course, because Frax Share is their governance token, which you can stake to get vote escrow Frax. Depending on your lockup, you're going to earn more or less yield. Frax is, of course, their stablecoin. So just remember that FXS is their governance token. This is the token that will capture the upside if they generate more revenue via the VE Frax staking system. And then Frax is their stablecoin, which is, of course, pegged, or at least algorithmically pegged to the US dollar, which allows the ecosystem to do all sorts of things like offering money markets like this one, as you can see in front of you. Frax Lend launched last year. As you can see in front of you, we've got the entire asset base, or the markets that they enable you to borrow and lend against. And I think it's been a great initiative to the Frax ecosystem. But there's two major upgrades coming now for the Frax ecosystem, which I think are quite substantial. Firstly, you've got Frax Chain. Frax Chain is basically Frax's own EVM compatible layer 2, which is likely going to launch before the end of the year, so in Q4 2023. It's going to be a hybrid solution, including both optimistic and ZK rollups, which will utilize Frax ETH as its gas token, which actually gives Frax ETH more of a value proposition and more token utility, and overall is going to enable the Frax ecosystem faster transaction finality and decentralized sequencer capabilities. The chain will be able to implement an EIP 1559 type mechanism where transaction fees can be burnt, and this value can accrue to VFXS holders. So of course, the more transaction volume that happens on the network, the more holders of the token are going to receive. It's a token designed to earn long-term yield for its holders, and users can lock FXS tokens for up to 4 years and earn 4 times the amount of VFXS. And that's obviously also one of the strategies in their tokenomics that incentivizes people to hold the token for longer. So that's cool as well. And then you've got Frax V3, which is the second major upcoming initiative, which is a trifecta of groundbreaking enhancements, one of which is going to facilitate real-world assets, but is also going to implement a bonded algorithmic money market, Frax governance, which is a trust paradigm, and then Frax bonds as well. And this is one of the really interesting ways that Frax is going to offer yield opportunities on chain. So lots happening with Frax Finance. Now, there are some downsides. I don't just want this video to be a Frax shill. I want to remain objective in every video. The first downside is when you do try and undertake a lot, sometimes you can open yourself up to vulnerabilities and risk. So this could be protocol risk in terms of a deployment going wrong. This could be regulatory risk because, you're entering uncharted waters with a lot of this stuff. So that's one thing to keep in mind. It is focused in the sense that it wants to be the biggest DeFi platform. But when you try and undertake things like new chains and all this stuff, it does come at a cost financially and also in terms of just bandwidth from the team. Now, the team's been amazing throughout the bear market, but that is obviously a risk to note. Another risk is the regulatory side of things. DeFi is entering a bit of an inflection point at the moment in terms of the SEC's propensity to actually come after DeFi protocols. And this is something we're going to see, I think, unfold a lot more over the next year or two, is DeFi protocols actually coming under SEC scrutiny. And of course, DeFi is DeFi. If it's built in a decentralized and immutable fashion, it means it is relatively protected, but you still have to be wary of it. And depending on what the regulatory outlook ends up becoming over the next couple of years, there are obviously going to be big changes to DeFi and the way you can operate. So does that mean Frax is going to implement KYC? Is that going to affect the user base? Are they going to have to shut down operating in some countries? We don't really know. This isn't a Frax specific issue, but of course when you have a stable coin involved and when you have yield involved, whenever yield's involved, it's easy to argue, at least in the SEC's eyes, that you have essentially on-chain securities being issued. So that's the argument they may make. Of course, Frax is a DeFi protocol. It's really built for this, so it's not a headwind that's stopping me from personally investing, but it's a headwind that I'm aware of in the future, which is obviously preventing me, and you shouldn't do this anyway, from going all in on Frax. So you always have to be careful when it comes to allocations of tokens in your portfolio. For me, Frax slots into a nice part of my portfolio that wants exposure to real-world assets, that wants exposure to DeFi. But of course, you never go all in one specific protocol, and Frax for me is probably weighted at less than 5% of my portfolio. But if you don't have it in your portfolio, then I suggest you just look more into it. Do some research, see if it's something that you want to invest in. If you don't, that's cool. this video isn't financial advice. It's not supposed to sway your opinion. But if you find any of this interesting, then definitely do some research into it and check it out. And yeah, research it in your own time. We're trying to build portfolios here that are going to be relevant next bull run, or whenever we see sectors like RWAs take off and get an influx of liquidity. The last thing we want is to be holding old, boring altcoins that don't have upside. I'm looking for upside in my portfolio, and I'm trying to create a really well-crafted portfolio of assets which have huge potential next bull run, or as I said, not even next bull run, but whenever a specific sector takes off, because next bull run might be very different. We may see specific sectors outperform. We may not see just everything explode like it did last bull, which I think was almost a bit of an anomaly, an outlier bull run, just given, the crazy circumstances surrounding 2021. So you have to be a lot smarter now as investors, and, that's why you never go all in at once. I'm DCAing in over time. I'm taking the slow approach, keeping enough stable coins on the side to make sure that I have enough bandwidth to DCA over time. But keeping in mind, I want to position myself for what could be a really exciting sector, and that's why Frax is a part of my portfolio. Now, in light of the comment that I just made about positioning our portfolios in sectors that have significant upside next cycle, I think one of the sectors with the biggest upside for adoption next cycle are protocols which are enhancing the usability and user experience of crypto, because crypto has a big problem. The big problem is that for the average retail user that's coming into the space, it's practically unusable. Like, it's very, very difficult to maneuver through self-custody, MetaMask exchanges. Like, the rigmarole of entering crypto is so difficult. And even for existing users, the UI is nowhere near where it needs to be. And I don't know if this is because of a lack of competition in the space, which is one of the number one prerequisites for fostering innovation, or whether it's just due to like a lack of funding or a lack of foresight. I just feel like the applications in crypto right now are really hard to use and really difficult to get a grasp of, at least compared to traditional Web 2 applications on your phone, which, 99% of applications are intuitive. It just doesn't seem to be the case in crypto. So next cycle, one of the things I'm really looking out for are protocols which can help enhance the usability of crypto. And dappOS is one of these, as you can see in front of you, that I've really got my eye on, and I partner with them as an advisor because I believe that they're building something which is solving a big problem in crypto, and this is the usability of crypto. So I have talked about this in past shows, but if you haven't watched the shows, they're essentially backed by some of the biggest names in crypto: OKX Ventures, Sequoia, Marana, Blue Run, Binance Labs, KuCoin, Foresight, Hashkey, etc. And they are enabling you as an intent-centric operating protocol to get a CeFi user experience whilst using DeFi. So, for example, if you're using an application like Perp, which is a perpetual exchange, instead of having to swap between different chains and transfer liquidity across the chain and use multiple clicks to do all these transactions and sign transactions, they essentially just enable you to keep it super simple and have all of your liquidity concentrated in one place. And they launched their V2, which enables you to have a much better experience whilst utilizing these dApps. Now, they just announced a very strategic partnership with Manta Network, and what Manta Network is it's a layer 2, a ZK knowledge proof powered modular ecosystem that is privacy focused, and in my opinion is one of the most exciting layer 2s in the space. Now, dappOS has just partnered with them as an ecosystem to make the chain more accessible to everyone via integrating Manta assets into the dappOS unified account, which is essentially going to simplify the interactions for mainstream users. And Manta, on the other side, is going to run a dappOS server node for faster and cheaper asset transfers. Cooperating with public chains, I think for dappOS is really smart, and public chains, would be considered something like Arbitrum, or in this case, Manta, which essentially enables them to reduce the friction or the barrier for adoption for new retail users to use these chains via providing an intent-centric UX, and will enable these chains to attract more users and more TVL as they become more usable. And if you've ever used dappOS, or if you have had the experience of trying V2, as I talked about in my last video, you would understand what the value prop is for the users. It's honestly an amazing experience, and that's why I've put the link in the description below if you are a trader on some of these dexes and want to try it out. They will be rolling out to more protocols in the future, but if you want to swap on a dex like Perp, you can actually do so now using their V2. The Manta partnership, though, I think is a fantastic one, and I think it's going to be an amazing example of how we can make DeFi much easier to use for retail. And they have this ecosystem growth program, which essentially is giving $10 million in liquidity support to cold start start applications, the intent-centric user experience to reduce the barrier of adopting Manta dApps, a non-profit node to boost assets flowing into Manta, and a holistic branding and marketing program between the two parties. So this is awesome to see, and hopefully it goes one step further towards creating a crypto ecosystem which is easy to use for retail and existing users alike, because let's be honest, if we want to achieve mass adoption, this is exactly what we need. We can't keep the current paradigm going, or it just won't work long term. So if you want to check out dappOS or use it, check out more information, follow them on Twitter. I'll leave the link in the description below. I'll also leave the link to our show partner Soil, which is a real-world asset protocol. And if you want to learn a bit more about the real-world asset sector, I'll leave a link below to the Binance report, which I also recommend you checking out if you want to do some reading in your own time. I hope you enjoyed this video. I hope you got some value out of it. Let me know in the comments what you thought below, and give me some suggestions maybe on topics you want to hear more from me in the future. If you enjoyed, subscribe. If you haven't already, click the like button. Thank you guys for watching the entire video. Slightly longer one today, but I think it was definitely worth it because I had lots of information to share. Hope you have a lovely day. I will see you later in the week. Peace out.